Hi, it's Paddy Hirsch at Marketplace, here to talk to you about the word subprime. I've been hearing a lot about the word subprime recently, mainly because of what's going on with the Federal Housing Administration. What's happening is the FHA has been kind of charged with rejuvenating the mortgage market, and a lot of people say that it is lending money to subprime borrowers, people who are not prime borrowers. And people are talking about subprime lenders and subprime loans, and there's some real confusion over what this word subprime actually means. So let's see if we can spell it out a little bit. So when we talk about the word subprime, as I say, it's attached to the word loans, it's attached to the word borrowers, and also, of course, to the word lenders. Okay, but what does subprime actually mean? Well, if we divide the word into two, here's this word prime. When I think about prime, I think about steak, and what that says about me. So here's a steak, all right, here it is, fresh off the grill, steaming and delicious. Now, I was looking at the website of the USDA the other day, and I was finding out what it is that makes a steak or a piece of meat prime. And one of the main things is marbling. So the more marbling there is in a steak, the more prime it's liable to be. And marbling is, of course, fat. Okay, so how is a steak like, say, a subprime borrower? Well, if you think about the more fat that there is in a steak, okay, the more prime it becomes. Likewise, the more fat there is in a borrower, the more prime he or she becomes. And when I say fat, I mean money. So say the more money they have saved in their bank account, or the more money they earn relative to the loan that they've taken out costs to service each month. I'm talking about cushion. The more cushion there is, okay, the more flexibility there is, the more likelihood that they're going to keep making their interest payments, the more prime they become. Okay, so prime is basically fat. And that means that subprime is lean. If you don't have very much money in your bank account, or maybe you've got no money at all, if you don't earn that much money every month compared to the amount of money that you're borrowing or have to pay to service your loan, then you are lean, you are subprime, okay? So how can we actually quantify that? Well, Fannie Mae helps us out with that, okay, because Fannie Mae has got some criteria which it uses to identify prime borrowers. And the first of which is a FICO score, like a credit score, of 620 or more. The second is the amount of deposit that you put down. If you put down 10% or more, okay, that makes you more likely to be a prime borrower. And thirdly is the amount of money that you pay out in comparison, the amount of money that you get in comparison to the size of your loan. So say, for example, if it takes you 45% of your income or less to service your loan, that means that you're prime. So your servicing, okay, is 45% or less. All right, so if you fit these three criteria, okay, Fannie Mae will call you a prime borrower. And many people use these parameters when they're talking about home loans. And indeed, when we're talking about the FICO score, people use that as well for other types of loan, credit cards and boat loans and student loans and all sorts of carry-on. And of course, they're looking at other things as well, like your credit history overall, whether or not you've ever been delinquent, if you've ever been bankrupt. So they look at all of these to determine whether or not you are a subprime borrower. Okay, so that we've dealt with borrowers there. So what about the loans? Well, loans that are subprime, okay, are often the kind of loans that are lent to subprime borrowers. By their very nature, they become subprime because they are riskier, okay? In the same way that you're riskier if you're lean, likewise your loan, if it's structured in a certain way, becomes riskier and it becomes subprime. So for example, in the case of home loans, we have these 228 loans. You have this rate for 2 years that jumps for the next 28 years. Or maybe you have, interest-only mortgages. Those kinds of exotic mortgages qualify as subprime loans. And with credit cards, for example, it's very high interest rates or high penalty rates. Okay, these are subprime. The reason those rates are so high is because there's a lot of risk attached to the borrower. Okay, so those kinds of loans and the borrowers, they intersect in that respect. So what about lenders? Well, lenders aren't subprime because they haven't got much fat in them, because in many cases the lenders have a lot of fat in them because they're making a lot of money off the people that they lend to. A subprime lender is simply the kind of lender who, here's a little pig, who lends to subprime borrowers and who makes subprime loans. Now, a lot of people say that because these subprime lenders tend to lend to people who are subprime borrowers, okay, they are people who often are of low income. They often come from ethnic minorities because they don't have established credit records or whatever it may be. A lot of people call these people predatory lenders. Not necessarily a fair designation all the time, but it is the case in some cases. But the reason that these people lend to risky borrowers, like these subprime borrowers, is because they charge enormous interest rates. So they're liable to make a lot more money if these subprime borrowers actually keep on paying their loans. And of course, the reason that they're charging that kind of interest is because these borrowers, because they're subprime, are riskier. So you can see the cycle there. So what are we worried about at this point? Well, we're really worried about the FHA. That's where this is all stemming from at the moment, because the Federal Housing Administration has been charged by the government with kind of helping to move the mortgage market and keep it going. See, the mortgage market is key to the economic recovery. As people buy houses, they go out and they buy stuff to put in the houses, and you have this movement of money through the economy. It invigorates. And so the government wants the FHA to go out and underwrite, because it doesn't actually loan money itself, but it wants them to underwrite loans to all sorts of people. You see, the banks have raised their credit standards, so it's difficult to get a loan from a bank now. Sometimes they've raised the credit standards even higher than Fannie Mae's prime standard. So what the FHA has done is it said, okay, well, we'll fill that gap. But in many cases, people say it's going below that gap. It's lending to subprime borrowers, okay? And that's really risky, because if the economy deteriorates, if jobs continue to decline, it's a lot more likely that people aren't going to be able to make the interest payments on these mortgages. It means they're going to weigh down the FHA, they're going to weigh down the government, and it's going to leave all of us out of the frying pan, or out of the fire maybe, into the frying pan, getting grilled and very badly needing a drink.